show you our screens and do the PIP picture in picture. It is actually a lot harder. But again, we want to do these things because we want to stream it out to multiple screens. We want you to be able to enjoy it. We want you to be able to see like what I'm talking about when I'm demoing something. Also, we had another last minute change, so our guest wasn't able to make it, but that does not degrade this live stream at all. We came up with a great show showing you some very timely, really cool things that we're doing in innovating and trying to help our clients really connect how they're investing with how they want to invest, with even stress testing their own portfolios so that they can see the range of outcomes that are possible in the future depending on what happens in the future, because we don't know, right? If we did, then it would take a huge dynamic out of how we invest. Rate of returns would be a lot lower. There wouldn't be as much fluctuation. Maybe some people wouldn't mind that, but I guess that is the reality of us being emotional human beings rather than computers, so we'll have to live with the way that it is for now. So today, really what we're talking about is dynamic portfolio and investment construction, portfolio construction and investment management. And we're also going to touch on a little bit of the Department of Labor's fiduciary rule, which went into effect today. So again, very timely, very timely. So what does it mean? How does it work? What are some things that good investment management firms like us are doing to go the extra step? I mean, we're already a fiduciary, so generally it's less than 10% of advisors that are fiduciaries to their clients all the time. It may be even a small time, not just but a fiduciary means that that organization or person has to put your interests before their own. So it's a really interesting concept. I think a lot of people think that all financial advisors and planners are looking out for their best interests, but regulatory wise, it's not the case. Most people are good people, but again, most people think that we're doing what's right for people, and there's a lot of people that are, but there is no regulatory requirement to do that, and a lot of times it's buyer beware, even though most consumers don't necessarily think that is the case. And the Department of Labor was trying to change that. We'll see if it sticks around under the new administration or what. So for now, it was crafted in a way to where it really just couldn't be stripped out or even defanged. But we've heard lots of rumors and what so that they're coming up with rules to replace it or possibly defang it, whatever the case. Again, most things that we tell people are, hire a fiduciary advisor that'll sign a fiduciary oath to you saying that they'll be a fiduciary to you all the time, and you'll be okay. You don't have to worry about what necessarily the Department of Labor or the SEC is going to do per se. That could be held to a legal standard. So anyways, so let's move on. I want to get into the portfolio stuff. We're going to show you some really neat things. So obviously right here you can see my screen. We're going to zoom in on it so you can see a little bit better. And for our clients, let me kind of portal. And if you've watched any of our stuff before, you'll know that you've probably seen this before, and it's not unfamiliar to you. If you are a client, you probably use this all the time. But when you log in, this is how you see things, and you can link up even your outside investment accounts. We'll put all the accounts that you hold through us into here, and you can link everything, and you get a good view of how everything is. Now, from our side of things, this is actually one of our primary financial planning softwares. It's actually from a company called eMoney, which Fidelity now owns, and the product is actually called EMX Pro. And so when we get into here, we have lots of integrations into here. So we have two actually sophisticated risk tolerance questionnaires. So that one is called Phenometrica, and the other one is called Riskalyze. And these help us really get the pulse of where our clients are, staying up to date, so if something changes in their life, like a death in the family or some traumatic experience or something good, or some of our younger clients, as they get more comfortable and learn about their investments, they may get more aggressive and can tolerate more fluctuation, which generally, if you can tolerate that and we invest more aggressively, statistically we'll make a higher rate of return. However, we can't tolerate that short-term up and down. It can be really bad for people. And it's why when we look at various, there's different studies that say different things, but the average investor over time is somewhere in between, 1% to up to 7% per year underperform the markets over the last 10 to 50 years. So there's multiple studies that'll go all the way, I think the Dow bar goes all the way out to like 48 or so years. So it's really interesting. But from here, we can do lots of stuff. And so we have very good integrations and research and what so through Morningstar. So we can come down through here and say we want to look at a portfolio, and we can say, you know what, let's look at, let's see, let's take this Orion Investments down here and say we want to make a report so our client can see exactly what the makeup of that is and what the past history of returns. So in this one, again, this is just a demo account. This is not necessarily how we invest per se for our clients. This is just demo data that imports from eMoney so that we can show potential clients just how things work. But it'll automatically bring it in here, show how much we have in cash and bonds and stocks, and how much are large and medium and small and international, and how well did that do in the past, and how much were things down when the markets were really bad. So in this one, it is comparing versus the S&P, which is not a good comparison for this one because this is a moderate portfolio. So, when the markets were down between here, almost 50%, this portfolio was only down 19. So again, people can really get a good view, of where their money is invested and how. We can do this on the fly anytime a client comes in. We can see what their expense ratios, how much is in developed versus emerging markets. It's a really cool report. Or we can go down in and we can say, I want to know how much, what are our top holdings, in terms of like the actual things that we hold inside of there. So, UGI, Apple, Microsoft, Amazon, but really for most of our positions in here, this one's a little bit concentrated. But again, this is modeling somebody that works for that company. But otherwise, we don't have more than 2% in any one company. That's really good. But we can look at this really fast and show our clients exactly these things. One of the new things that we've done is integrated this new thing in called hidden levers down here. And so I'm actually going to go over to here to where we can, kind of pull up one of our sample type clients that's more along how we give people advice on the investments. And so when we look at this, this is a really sophisticated program. And what we want to be able to do is kind of show our clients based on how they're invested, what is the likely outcome under different scenarios. So this is one that people just find riveting, but we can look at what happens under some of the Trump scenarios here. So we could say, what if the administration and Congress get through the tax cuts that they want to, do the extra infrastructure or what, so in a 1 year period, we're looking at the markets up at about, the S&P up about 13 or so percent. Based how we're invested in here, which is like kind of moderately aggressive, we would be up about 10.7%. So again, you say, well, that's not as good. Well, again, you got to realize our clients aren't 100% aggressive, and this is 100% aggressive right here. If we were to come down here and say, what happens if we kind of get in some trade wars with, China and what so in terms of protectionist policies and but there was still some economic stimulus inside of here. Now you can kind of see there's lots of stuff that's being taken into account, from CPI to the euro to oil to what are our T-bills, the government bills, unemployment, and then there's secondary, and there's more in here, but these will be adjusted based on this. So under this scenario, over a year, the S&P would be down about 8%, and this portfolio would only be down 4%. Okay, and we can even come in here and say, all right, so what about even worse? What if like immigration got totally halted? So in this scenario, it's saying the markets would be down somewhere around 26%, okay, over a 1 year period. And again, where do they get this data? They're not just making it up. It's basically what's happened in the past in various countries, economies, circumstances of similar types of events happening, and then what did it do to, this company is called Hidden Levers, what did it do to all these levers on average over time? And it's saying if something like that happened again, let's move all of these and what would the markets have done? And then based on how you're invested with these different funds, how would your portfolio react? So the markets will be down 26%, and in our moderately aggressive, we would only be down 19%. Now we can do more traditional type things. I just show that because it's a popular thing right now. Who knows, maybe we'll get a tweet about it. So let's go over here to something more traditional, and we can just look at like baseline scenarios and say, what if the S&P was just down 10%, okay? And so we can look at this and just say, okay, the market, there you go, 10%. Well, what would, if you want, you kind of see what would it change on these other markers. But if the S&P was just down 10% in the most likely scenario, we might be down right around 6.4%. You know, so let's look at a positive scenario. So, you know, what if things are really good and the S&P is up 20%? Okay, now we would be up 17. You know, I mean, again, we can't predict the future, but again, kind of looking at the past and trying to model forward, and not just doing something simple, but thinking about all these other variables that are built in when a scenario like this would happen. And you can see that, and we could show this, you know, to our clients so they can get a kind of an idea of how much of the upside would they be willing to give up to protect them from the downside that they're worried about. And so we can even look at, I mean, there's lots of things in here. We could look at climate change. We could look if we actually hit deflation. You know, what if Obamacare was replaced? What would that look like? We could come down here and look at, you know, past crashes. So we could say, you know, what about the financial crisis from the end of 2008 to the beginning of 2009, or even looking at the tech bust right there. So like, let's look, I mean, this is one of the worst in history, so you can pull this thing up right here, you know, and we can look at the financial crash down. And so basically when we're looking at this, we're looking at negative 47.8. So we would have been down about 40.1%. And we can pop it up to a 1 year period. And we kind of see that's a little bit better inside there, but it's not too far off. It's already got a date range. So it's really interesting to see these things, to see, you know, what is the differential there. You know, that is, you know, almost a 20%, you know, less down, which is what we're going through with portfolios. Somebody says, I can't take that. Well, then maybe they need to be moderate. We can pop the moderate portfolio in there, test it, show the client, and they say, oh, all right, I'm more comfortable with only 27% down in a scenario like that. But instead of on the 20% up being 17, maybe we're only 13 or 14. I mean, are you okay with that in terms of that? And then our long-term rate of return, when we look at a 10 or 15 year period, is going to be this on average. And so that kind of takes me to another. We're a really interesting company, and we just don't do one thing. So we like to have lots of technologies, and we like to error test and breach each other and show clients the differential. And so in here, we can kind of compare those and what so. Anytime we do this for a client, up here, we can run the report, show it, put it in their vault. Our vault is like the document storage within their RFPW up here, where we could just save that for them into the vault, and then anytime they meet with us, or, you know, even if we're just doing a video conference where I'm doing this for them, kind of like you're watching it, except on their individual stuff, then they can come in here, go into their investments folder, and bam, we put it into there for them to be able to see it whenever they want to. So this one's a little bit different. This is from a company called Extrema. We use them for three things. This product is called Portfolio Crash Test. So it's very similar to the Hidden Levers, except I think it does a little bit more higher level in terms of just showing lots of different scenarios. And also we can model out a little bit in terms of like withdrawals and savings under those scenarios as well too. So in this one, I just kind of loaded up our moderately aggressive primary just model portfolio. And you can see here, here's like the different scenarios that it has, you know, rates rise, inflation, the markets are doing good, okay? So like when we look at it, it'll give us a little bit more, and we've even got more detailed descriptions of what those mean. You know, what if stocks were up 30%? We'd be up 24.6. You know, what if we get the tax cuts and some of the stimulus that we were talking about, you know, up at like 15.7. What would we expect long term from this once we average out all the short term things that we can have? You know, about 7.4% per year. And our yield would be like, what are the dividends and interest and what's so paying out every year? Then we can look at some of the negative things, like what if happens if we get into some trade wars, or emerging markets have a hard landing. So like say China, this one's almost a little outdated. But again, stuff happens over and over again. But you can see a lot of these different things. You know, what happens if China's corporate debt was to implode? And then the Fed has its own like stress testing scenarios, and this is their severe scenario. So the markets would be down, I think in this something like 58% or what so, and a portfolio would be down about 40. Now that's pretty horrid, and it's past the third standard deviation, which means 99.7% of the time this is not going to happen. But again, you get into chaos theory and a lot of these things with, you know, a lot of things. There's a lot of people saying, statistics may say this, but you have a complex system that's more chaotic, and you may have more of those third standard deviation type events than what statistics would predict, again, because we're not machines or computers, we're people. But the cool thing we can do on this as well too is we can compare. And so, here's our conservative plus versus our moderate. And you can kind of see, the upside's going to be smaller because we're holding more bonds and cash and to pad anything bad from happening. And so our average rate of return is going to be lower. When the really good things happen, it's going to be lower. But you can see the downside is significantly less here. I mean, that's still, pretty hefty. I mean, a 27% decline. But again, the markets are down 58. I mean, that is a good bit less than half. And with that much in conservative, so we would have, something like 60% in conservative in this portfolio, just from, buying low and selling high. This portfolio would recover very fast, as long as our clients let us do our job to continue to manage things. And then if we want to see, well, what are the details of how things are made up? So again, this is kind of the basic. If we just wanted to look at, how much is in, stocks, how much is in conservative and cash, we could see that right here, and you could see the differential on a really high level. If you wanted to break it down even more and say, well, how much are in large and medium and small and emerging markets and so, we can check that out and really see the difference between the two. I like this. This is a really cool thing. Now, if you're not a statistics person, it doesn't mean as much, but what you can do in here is look at the first, second, and third standard deviation. And, the first is 68%, 95, 99.7%. It's basically saying, so when we look at this, let me explain this to you, it'll help you, is within 1 year, 95% of the time, your return would be within negative almost 10% and positive 24.5. Most of those are going to be inside of there, okay? Now you can look over here, the more conservative one, 95% of the time, you're going to be between 4.75% and almost 16%, okay? And so this is how life is more. Life is not like, this is what's going to happen. It's like, here's the probability of the chance that this is how it's going to happen for you. And so this gives you the range. And generally, the longer you go, the more it's going to come out to where you want. So it says over a 3-year period, you could be down 7% or up 52. So that's a lot more attractive, right? Over here, there's barely even a probability that you could be negative. If you took this to the 5-year, this graph doesn't do it, but if you took it to the 5-year, you wouldn't even have a chance of being negative in the second standard deviation. Now again, now we say we want a higher, almost all scenarios that could happen. Now, we can't tell anybody for sure what would happen, like guaranteed, but you can see how the range spreads out a little bit more. But the probability that you would be over here in these tails is really low. More than likely, you're going to be somewhere right in here. And if we look at that middle, that's that average return that we were seeing before. So this is a really cool graphical way to see it. And even though we're just showing you model portfolios right here, we can bring in like a prospective client that just wanted to see, can you show me how you invest versus how my portfolio is in my 401k? Or I'm having it managed by one of these bigger brokers, or, I just have some automated robo thing through Betterment doing this. What does that actually mean? And, one of the things that we're really seeing in the world out there, it'd be nice if a computer could do all this, but until we get something like Jarvis, it's like that AI that Tony Stark has in Iron Man, that there's some AI that has emotions that can explain it to us in a way that these things are not going to replace, because a lot of the reason why we underperform in so is because of our emotions and because of just the way that we behave as human beings, and evolutionarily that was successful, but we didn't evolve to do statistics and investing well. And so what we do as these good financial advisors, what we do is try to take the statistics of things and helping you have a high probability of having a good outcome and turn it into the human interaction of how is that actually going to make you practically successful and have you accomplish the things that you want, like retirement or helping your kids with college, or, making sure that, with your estate plan, when you pass away, if you have a special needs child or you have a special charity or religious affiliation that you want to take care of, that these things happen out well to the best of our ability. Again, we don't know what the future is going to do, but if we do this stuff well, we have much better outcomes than most people have. And then this is a cool little, I'm not going to spend too much time on this, but we can, based on the amount of money that it is for people and how much they're thinking about withdrawing or whatever the case, then we can show them this is kind of arbitrary right now, but I'm just giving you the idea of, if we save more during the period that we have left to save, and this is what we're withdrawing over, and how much are we withdrawing versus saving, how long is that cash flow going to work, and what percent is it, can we live off of that, and then we can manipulate it inside of here. So again, this isn't quite as rigorous as the financial planning software. It's not near as rigorous as the financial planning software, but the cool thing about this is how dynamic it is. It lets people visualize in their head kind of what they need to do to see that. So I'm kind of running short on time, but I just wanted to show you this real quick. And this software right here is called IRA Fiduciary Optimizer. It's another one from Extrema that we're starting to use, and it really comes from the new Department of Labor fiduciary rule that's gone into effect. And we've always, Rebel Financial, since we started, always been a fiduciary to our clients. We try to tell our clients exactly the good and bads of everything. If we ever have a conflict of interest, so say a big conflict of interest in what this rule pertains to is if somebody rolls over their 401k, in this example I was using a habit, rolls over their 401k to us, then we get paid to manage the money when they roll over to us. If they were to leave it there, we don't get paid on that. And so that is a big conflict of interest. And traditionally in the past, most financial advisors haven't disclosed that, or they really gloss over it. And you shouldn't. You should tell people, this is how much you're paying right now, this is how much you're going to pay when you're with us, and this is exactly what this is breaking down to say, in this plan right here, this is the total fees based on, us talking about a $237,000 rollover. Here's the dollar. In the plan you're paying $2,124. With us, you would pay $3,281. What is the percent of that? And then we can get into, these are more complicated, kind of investment statistics. But we can look at different things. What is your retirement plan's average expense versus the average in the country? What are our fees versus the average in the country? What are you getting in your retirement plan versus what are you getting from us? So if something is more expensive, but you're getting a lot more from it, like some of the tools I was showing you in the financial planning, etc., then, it could be a heck of a deal. You can't, compare, getting a little teeny itty bitty cherry versus getting a whole cherry tree. It's not the same thing. We could say apples to oranges, a little cherry compared to an orange tree. Whatever, analogy strikes you better. But here you can kind of see the funds, and a lot of big 401ks these days are very limited on the fund lineup versus we're pretty much open architecture. But again, we just wanted to kind of show one of our models in here of how we're actually investing people's money, so it's very practical. And then the report that I had brought up, is for the client to be able to see these things, have a copy of it, and really see and make an informed decision. And this is a lot of what the fiduciary rule was about. It was about basically saying, show people what they're doing, show people what they're paying, show them if there is a difference in there, because you don't just have to sell the cheapest thing. Because cheap, a lot of us have learned, is not the best thing out there most of the time. But we need to have the information given to us by people that we think are fiduciaries. 90% of people think that all financial advisors are fiduciary, their financial advisor is, which is almost opposite of the reality. So we need the information so that we can make a good information for ourselves when you're rolling over a 401k, or even an IRA to an IRA if you're changing companies or what so. And tools like this, we invested in a good bit to be able to even be more transparent than we have before, so that people can see that. And then again, showing those different scenarios, how much we could be up or down, is because investment companies could actually manipulate the numbers by making you more aggressive in their IRA and you are more conservative in the 401k, and that's not an apples to apples comparison. You got to try to make as close to an apples to apples comparison as possible. And so with this, we can actually show people, what is exactly the difference of this is over a 10-year period, so that person would actually pay us $18,000 more. Now, when we go back and look at the performance results, then it's actually a good positive, plus there are a lot of other servings that could provide. But people need to know to say, over a 10-year period, is that a good deal? Is that a good deal for me and my future, my family, etc.? And so we have supported fiduciary rule from the beginning. So has the CFP board, so Certified Financial Professionals, and then the FPA, the Financial Planning Association, and NAPA, which is the National Association of Personal Financial Advisors. So we are members of all of those things. We support the fiduciary rule. If they claw it back or defang it or whatever the case, we think that is a negative for the average investor out there. But again, you don't necessarily need the government to tell the institutions what to do. I think as a society we probably do. But you personally, if you're watching something like this, you probably have an interest in what's happening, and all you have to do is find an advisor that is a fiduciary to you all the time. Ask them to sign a fiduciary oath. Really, an easy way to do that is you can look up advisors on NAPA. NAPA has it, so it's NAPFA. It has a thing that says find an advisor. There are a couple other organizations, the XY Planning Network, Garrett Planning Network. All of these people are fiduciaries. They're fee-only advisors. All good ways to find a good financial advisor. But again, we thank you for joining in. I hope this was insightful. I think it's very timely with what's going on. Gives you a better understanding of some of the regulatory things that are coming down, why they're important, how they pertain to you, and then just some of the innovative things that we're doing, not only to comply, but to take always the level of care and investment management and portfolio construction for our clients to that next level. So it's beautiful here. I hope you guys are going to have a beautiful weekend. Hopefully you'll be able to jump into some body of water, because I think it's going to be hot. But otherwise, have a super finish to your week, great weekend, and we'll see you next week.